Welcome. I'm joined here by Marin Katusa. He is with Katusa Research and bringing in some insights about the market and what's going on and what they cover. Marin, it's great to have you here. How are you?
Great.
Pleasure to have you here. Really excited to get started. We do these state of the markets interviews with a couple of different experts in the industries on the Benzinga platform every Friday, releasing them next week, giving our traders and our investors and our readers insights into what's going on in the markets on a weekly basis. So, to kick us off, though, before we get into anything specific, can you give us a quick intro to Katusa Research, what you guys do, and what your specialization is?
Sure. So our specialization is resources. We've been around for over 20 years. We're the largest independent resource publication in the world, which means you can't buy us. And over the last 6 years, we've probably been top three financiers in the resource sector globally.
Fantastic. Okay, so what are some of the things that you guys do on a daily basis when you're doing your research, producing your materials, looking up, whatever it is that you guys do? What are some of the day in and day out kind of tasks that you guys are doing when you're looking at the markets?
So from our standpoint, you have to have the macro view of what's going on. And right now it's all about the US dollar, but also when you come into resources in the equities, the publicly listed companies, you have got to go to the site visits. Hence why we've been to hundreds and hundreds of projects in over 100 countries globally, and understanding the technical details, what stage, understanding the risk aspects, the people who are running it, the political risks and the jurisdictional risk, the development risk. So mining and energy is a very difficult game. There's a lot of things that go wrong, and even if you think you know the things that could go wrong, you always get these black swans of new things that can go wrong. So boots on the ground and experience is an absolute must to succeed in this game.
100%. Okay, Marin, because this is your first time on one of our State of the Markets interviews, we've introduced you to the audience. I want to go ahead and dive into a growth versus inflation cross asset volatility report that we got from you guys. And we're going into some of the details here. It came out November 3rd, so just yesterday. Give us a high level overview to get started here of the global market internals as a whole right now. How bad and how long could the bear market last? What is the overall barometer of our economy and our economy as a whole across the world? What's your take on the global markets right now?
So what we wrote just on November was kind of a multi-month piece where about 7 months ago we said we're going to be entering a very difficult recessionary market. The velocity of capital will go down because interest rates are going to be going up. I covered a lot of these cross-inflationary aspects in a chapter in my book from 2021 called The Rise of America. And we really discussed how the US dollar, and I get it, so many people in the resource game and in the macro game think that the Fed is going to pivot here. I don't think they're going to pivot anytime soon, meaning in the next few months. The chairman came out and said, we're going to keep going even higher than he anticipated. He can't pivot and lose complete faith on that. And that has such important aspects. The US dollar, people don't realize that all these debt projects globally, the development projects in the emerging markets are in US dollars. That exposes so many new risks that people haven't even realized from a geopolitical aspect, using the dollar as a geopolitical weapon. That's happening in real time between Russia, Iran, and also China with the Taiwan situation. But if you look at it from a resource standpoint, you look at negative swap lines, which we talk about for the last 3 years in my publication, people who have access to the US Fed, the central bank's true allies. But if you're a company that's listed in the US and now you're trying to mine and develop projects in risky emerging market jurisdictions, what do you think the government and the locals are going to do to this foreign company that's making all this money, yet the government has less revenues because it's in US dollar? Their fiat currencies are going down in value relative to the US dollar. Expect higher royalty rates, higher taxes, and in many cases, absolute confiscation. So there's many unintended consequences and the butterfly effect of a strong US dollar. And if you think, like, look what's going on with gold, for example, the gold equities, the cross-inflationary pressures, even though gold's in, the mid 1600s as of today, as we speak, the inflationary pressures, the margins of the gold producers haven't kept up with the inflationary pressures, hence why they're down about, on average, about 50% year to date. So the strength of the US dollar is absolute key. It's going to stay like that for a few more months. And regardless of what people want, that's what the Fed is doing, and they're sticking to the plan.
Understood. Okay, because it's a very prescient topic right now, we had the jobs report number this morning. Give us a little bit of insight into this jobs number as it relates to inflation. And of course, with the Fed reporting their rate hike this week, 0.75%, what's your take on inflation and the jobs market being tied together, and what should we expect coming out of this next?
So Powell talked about lags, and the job report kind of came opposite of what he was just saying on Wednesday. So if he kept hampering how they have these high inflationary numbers, but all time low in unemployment. Then this report comes out today, and there's so many contradictory numbers. The reality is though still even with the job increase, it isn't yet big enough for them to pivot. There's speculation that this is the beginning of something bigger for the unemployment sector. And it's look, Amazon put out they're not a hiring freeze. Google's done reversal. Twitter's laying off people. So you look at it's going to increase, but it's going to take many months for the Fed to churn the ship around. And currencies don't move as fast as equities. And we are in a cooling environment. You mentioned, the growth phase. That phase of this market, this last decade of growth is the game. That's over. Now it's about reality, earnings, adding value, and we're now in a market of the traditional value investor. But I do believe we have more downward pressure. We're in the tax loss season entering here. You got another 2 months of pain. And then I think we'll have to see how the job numbers come for the next few months to see where the Fed's going to go.
Got it. Okay, so in your perspective, then, where would you kind of point investors to look at potential growth spots, if there are any, or any bright spots in the markets or in the economy right now? Where are some things that you could look to for opportunities, especially when we're in this kind of turbulent period with everything going on across the macro sector?
So first off, if your company you're invested in has high debt and their margins are shrinking, they're going to have to dilute. So you want to stay away. Number one is avoid the losers. And if you have them, take your tax loss because cash is king in this market. The US dollar is going to remain strong for the next few months. But when we talk about sectors that have incredible growth, without a doubt, the largest one in the resource sector is the carbon credit, the offset market. Next week, we have COP27 in Egypt. And you look what's going on in the NASDAQ with the SEC and the New York Stock Exchange. Companies are going to have to report their scope one emissions. That's their direct emissions, their scope two, their direct and indirect emissions. And eventually, just like what happens with audits for your financials, companies are going to start being audited on their carbon footprint, their emissions record to the market. So I think that if you're someone looking for a unique idea, that is a multi-trillion dollar sector. I call it the internet of the early 90s, and it's only going to grow. There's remember, not all credits are the same. There's different vintages, there's different types of credits, there's the compliant market, there's the voluntary market. There's tons of free stuff on it in our website. That is a sector that is going to be, I think, without a doubt, bigger than gold. And it's not just me saying this. If you look at Blackstone, BlackRock, the biggest traders in the world, the commodity traders, are saying we're positioning this to be bigger than the oil market, which makes up about 5% of global GDP.
Got it. And another part of this report here, you said it a second ago, cash is king, right, in this market. And I think it's really interesting that you brought that up because part of your report is talking about, when times are good, cash valuations for companies are going to be lower. When times are bad, cash valuations are going to be higher, right? And you also mentioned when you're talking about this, the cash costs coming higher over the last 2 years. Mine by mine basis, you can reduce the operational costs by improving efficiencies. It's part of your report in here. But what does this mean? You said that it means these new elevated costs of production for the most part are here to stay. When you're looking at this for gold specifically, does that mean that we're going to see an upward trend in the future? Does it mean it's a good time to get involved in that sector? What's your take on that as of right now?
So when you look at the big eight costs, you look at like manpower. Well, with many mines unionized, they can't just get replace people with automated trucks because there's huge capex costs to that. You have your existing fleet. You look at power costs; those have been high. So you're looking at over a third of your cost is manpower and energy. Those are not going away at any time. So you're going to have main costs. Things like the transitory costs, like tires, have doubled in cost. Dynamite's up 50% to blast the rock and crush the rock. Those ebb and flow, right? I remember in 2014 we had prices in tires is what we are today. Then they went down 50% a year and a half later. So those will reduce. But you look at gold specifically, And I'm in the resource market. I'm a major gold investor. I see near-term pressure, and people hate when I say that because I'm not a cheerleader for the sector. You have to be a realist and look at it. And over the next few months, and look, gold bounced $45 today because of the jobs report. Well, it's pretty irrelevant on the basis of things when you look at from a company perspective. Barrick, Newmont, they've had their all-in sustaining costs, not just their cash costs. Cash costs are at the site, but their all-in sustaining costs across the board up 20-25%. And those are the biggest producers in the world. The mid-tiers, building these projects, the CapExes, whether gold's at 1620 or 1650, it's kind of irrelevant to the bottom line of these companies because there's so many of these inflationary pressures, what I call crossflation on the actual site. So I do see more downward pressure, but with that brings opportunity. Crisis equals opportunity. So if you're positioned for myself, I don't want any emerging geopolitical risks. I see that as a horrible place to be. I think their taxes are going to be go up. There used to be a saying in the gold sector: God created the gold, but the devil took it and spread it around the world and put it into his favorite places, which are screwed up places. You're seeing a market now where you can get incredible valuations in Nevada, where I can take my kids in a car to go look at the operations that I'm heavily invested in South Dakota, where the biggest gold mines historically and great is king, in Utah, which people don't even realize is the highest operating gold mine in the world. Why do I want to go to places like Argentina where money goes to die, or the DRC, when I could go right here with infrastructure? And a lot of these projects in the US, you look at South Dakota, for example, with what's going on with Dakota Gold, they've never seen modern technology for 25 years because everyone went to the emerging markets. So resources are very cyclical. And for me, I like going to places where OPM, other people's money, when you look at the power grid, roads, infrastructure, shafts, sinking a decline in a shaft is very expensive. If you have that existing infrastructure, you can refurbish it, but you're already hundreds of millions of dollars of other people's money invested. So for my dollar, I want great as king, metallurgy is queen, and I want to avoid as much of the geopolitical risk as possible. And I think the US is the place to be.
Amazing. Really, really good insights. Those crossflation pressures, especially, really interesting topic there to look into. Marin, that's pretty much all we've got for you as of now. But I do want to ask too, for any investors out there that want to get more involved with Katusa, how can you interact with Katusa Research? Where can you get more of your resources? What's the best way to get involved here?
Just go to our website, katusaresearch.com. We've got incredible amounts of free material, decades worth of research published. It's all there. Every report I've ever written is there. And we have an incredible customer service staff. If you have any questions, drop us an email or phone call. It's all the info's there.
Amazing. Well, certainly looking forward to getting more people involved and talking with you again soon. Marin Katusa, Katusa Research. Thank you so much for joining us.
Stay well.